One thing to keep in mind is that, if you look at Fed fund futures, it's still projecting a cut in December. The Fed will not want to do, which is be a little forward looking, but we have a government shutdown that's continuing that is causing even things like air traffic to slow. And inflation isn't going to be gaining strength in a period like that. So if the Fed was acknowledging inflation's weakening now, I think it's even weaker in December at a time when the labor market is suffering. So I think if someone thinks the odds have dropped because of what the Fed said, I just think the data would support a very opposite picture.
Tom Lee opens by addressing a striking paradox. How can this still be called the most hated rally when the bears have seemingly vanished? He explains that while many investors claim they're no longer bearish, their portfolios tell another story. The real pain trade is still to the upside. Tom references the AI Investor Sentiment Survey, a key measure of high net worth investor attitudes. In 2025, it's averaged around 11.7, signalling persistent bearish sentiment all year, a level seen only 3 times in the past 35 years. Before we dive deeper, don't forget to like, subscribe, and turn on notifications for more videos on markets, crypto, and digital assets. Drop your thoughts in the comments. Your engagement helps the channel grow.
You think it's still the, quote, most hated rally? I just don't know how that still holds water given where we are. I mean, I interview people all day, every day. I've got no bears around.
Well, I mean, maybe some of the bears have gone to hiding, Scott, but because the last time we talked, I wanted to give you some quantitative stats. If you take AAII, which I think is one of the best surveys of high net worth retail investors, it's averaged minus 11.7 this year, negative 11.7. There have only been 3 other times in that survey's 35-year history where the year-to-date average has been negative. It was 1990, 2002, and 2022. So all those times have actually been associated with bear markets. And so sentiment has averaged this year what's consistent with a bear market. So it is the most hated V-shaped rally. Now, there may be some people who say they're no longer bearish, but their P&L doesn't reflect that.
No, that may be fair, which leads us to the potential of a chase into year end when they realize that what's at stake for them if they're not engaged.
That's right. And we know 80% of fund managers are trailing their respective benchmark this year. It's the worst in almost 25 years. So, and now they're given 2 things to work with. One is that seasonally, November's a good month, so it should be a positive month. And as far as earnings go, and you guys had a conversation about it earlier today, margins have been improving despite tariffs. And so it's showing you that companies, I think, using AI are able to expand profit margins. That's actually a pretty good tailwind because the tariff headwinds are fading, but the benefits from AI margin benefits are still going to grow.
Now, I'm a little surprised, maybe not much, but just because you have a history of liking small caps over the last year or so, but particularly coming off the Fed meeting, where the Fed chair went out of his way to say that December is not a foregone conclusion, and then underscored that with far from it, which obviously, if rates aren't going to go down in the trajectory that you probably thought they would, then small caps are probably not going to perform the way you thought they might.
Yeah. One thing to keep in mind is that, if you look at Fed fund futures, it's still projecting a cut in December. I think Fed Chair Powell in his statements did give you a window for why it's possible. One is he did acknowledge that inflation's effect from tariffs is less than they expected. And despite a lot of Fed governors talking about inflation widening, that's not the case. When you look at the CPI report in September, it was the highest percentage of components, 54%, that were in outright deflation. So in fact, inflation is falling like a rock. And the second was he acknowledged that rates aren't accommodative. They're just less restrictive. And so in a case where there's falling inflation and if jobs market's weakening, I think that that's a good reason for cuts to happen and in a way that's good for equities.
Yeah, but I mean, we were talking about December probabilities, Tom, before the meeting at like 100%. Now they're down. And some, like, Jeffrey Gundlach, who I interviewed the other day post-Powell, was like, could be 50-50. So maybe that particular trade gets paralyzed, if you will, between now and the next meeting, because we just need to see what the Fed's going to do before we become big believers in the small caps.
Yeah. Well, I'm going to do something that the Fed will not want to do, which is be a little forward-looking. But we have a government shutdown that's continuing, that is causing even things like air traffic to slow. And inflation isn't going to be gaining strength in a period like that. So if the Fed was acknowledging inflation's weakening now, I think it's even weaker in December at a time when the labor market is suffering. So I think if someone thinks the odds have dropped because of what the Fed said, I just think the data would support a very opposite picture.
That sounds scary is the death cross, right? Like what sounds scarier in a market than saying something's going to have a death cross? And so what I thought we could do is maybe just look at a potential upcoming death cross for Bitcoin. Now, death crosses in and of themselves are not great indicators because they're lagging. By definition, the death cross indicator is a lagging indicator because it's based on moving averages, which lag the price. So a lot of times when you have a golden cross, the price of Bitcoin dumps. And a lot of times when you have a death cross, the price of Bitcoin rallies. Now, we've gone through this many times, and what's interesting is despite how frequently we say it, the same thing just keeps on happening. Every time people go through the motions of, well, if everyone thinks it's going to happen, then it won't. And it just keeps on happening. Let's go through a couple examples. If you look at the last golden cross that Bitcoin had, it was in May. And we actually did a video on it back then and said, look, guys, while a golden cross sounds good, and you're going to be seeing it all over the place over the next few weeks, usually when a golden cross happens, Bitcoin dumps 10 to 15%. I believe we even said expect a 10 to 15% dump after the golden cross. And we got one, right? We got a 12% drop. Now, the overall rally continued, but we still got a 12% drop. And before that, we had a death cross on April 6th. And what did we say back then? We said, look, normally Bitcoin rallies after a death cross. And again, should they be named something else? Maybe, but that's what they're named. So usually on golden crosses, the short-term move is a dump. And on death crosses, the short-term move is a pump. If you believe that, then the only thing left to figure out, there's two things. First of all, will the death cross occur? And second of all, if we get a death cross and the price rallies, can it go to an actual new all-time high?
Now shifting to crypto, and Bitcoin in particular, Tom Lee and other analysts highlight another widely misunderstood signal. The term death cross sounds ominous. It occurs when Bitcoin's 50-day moving average falls below its 200-day moving average, a setup many view as a bearish indicator. But here's the surprise: historically, Bitcoin's death crosses have often preceded major rallies, not crashes. The reason? Both the golden cross and death cross are lagging indicators. They reflect past price action, not where the market is headed next. In short, what most investors fear could actually mark the start of new opportunity.
Are we going to get a death cross? The death cross, in this case, is defined by the 50-day moving average going below the 200-day moving average. The 50-day moving average right now is at around 114K. Because the price of Bitcoin is less than 114K, and if you go back, say, 50 days, and you look at the fact that we're replacing prices 50 days ago of, what was the price 50 days ago? 115K. We're essentially replacing these prices up here with these prices down here. And so because of that, the 50-day moving average is going to start dropping. It's going to start dropping. Now, the 200-day moving average, if you go back 200 days to see where Bitcoin was, it was actually at around 84K. So the 200-day moving average continues to climb because we're replacing these lower prices of 84K with higher prices of 109 or 110K. So it seems likely that the 200-day moving average is going to continue to slowly grind up, and it also seems likely that the 50-day moving average is going to start dropping. Now, there is no guarantee that you get a death cross. Like, there's a chance that if price can rally, the death cross could be avoided. And that's actually happened before, right? I think there's times where it has looked like you were going to potentially get a death cross, and then it didn't actually happen, right? Like where you start to see the 50-day drop, but then you still don't actually get a death cross. What's interesting is in 2021, when we had a death cross, the price of Bitcoin rallied. Now, there are exceptions, but if you go through most of them, right? If you look at 2023 and you look at 2024 and you look at 2025, you can see that the death cross marked a local low. Now, if you guys remember earlier this year, when we had a death cross, I told you guys back then that we will likely have another death cross in 2025 because that one happened so early. Normally we get a death cross in the third quarter this cycle, the third quarter, but then this year we got one in early Q2, and it looks like we might get another one in the fourth quarter. Now, if you go back through history, most of the time this works. Like, it doesn't work all the time. In 2019, it also worked. And we've also made comparisons to that. If you look at 2019, when we got a death cross, Bitcoin rallied, right? It rallied. And when it rallied, it actually went up like 43%. Now, back then, that led, unfortunately, to a lower high, but it was still a rally, right? It was still a rally. You can't go back in time and change anything, but it ultimately was still a rally. And you'll notice that Bitcoin dumped into the death cross, right? It dumped into the death cross, and then when we got the death cross, we got a rally out of it. Unfortunately, it marked a lower high. Now, if you go back through history and you look at sort of the death crosses at the end of cycles, you also had a death cross back in March of 2018. And what you'll notice is that if you waited for the death cross to sell, you would end up selling a local low at around 6,700. Now, the high was already in, but then Bitcoin rallied back up to $10,000, right? So it had a rally from the low of about 50%. And so, again, this is something we've seen on repeat. I think we could find some examples where it doesn't play out perfectly. 2021 might be an example or 2022, where you had a death cross and price ended up dumping shortly after the death cross. It still went higher later on, but it is to show you, well, one thing that this sort of has worked out is a lot of times the price on the day of the death cross, usually a month or so after that, the price is higher, right? Yeah. So that is something that kind of continues a month or two. That's something that we've seen play out many, many times. And the reverse is also true, right? When you look at golden crosses, when we've had these prior golden crosses, a lot of times it then leads to a short-term dump, okay? You can see that happen in 2023. It happened to a lesser extent in 2024, right? I mean, it didn't really happen if we're being completely honest. In 2025, as we already showed, when you had the golden cross, it led to a 10 to 15% dump.
Historically, when Bitcoin's 50-day moving average slips below its 200-day, prices end up higher about 70% of the time. Just a month later, a strong contrarian signal that fits perfectly with Tom Lee's broader theme. Markets often climb a wall of worry, with rallies few believe in and opportunities that emerge when fear dominates. So while the death cross might sound alarming, for experienced investors it often signals a bullish setup, especially in today's liquidity-driven macro environment. Together, these forces define what Tom calls the most hated rally, a bull market no one trusts, but no one can afford to ignore.